We're looking at an undervalued, high-quality dividend stock, which is Thermo Fisher Scientific. We're going to take a look at the historical performance of the company. We're going to dive into their income statement, their top-line revenue, bottom-line net income growth year on year. We're going to take a look at their balance sheet, their total cash versus their total debt. We'll also compare their performance over the last year and the last 5 years versus some well-known competitors. As always, we will take a look at their financial metrics, dividend safety, as well as what the institutions are doing. Are they buying or selling this company? And finally, we'll run it through our valuation model, getting to the intrinsic value, as well as the acceptable buy price given our investor margin of safety. We'll then get to the conclusion whether or not this is one we should add to our portfolios now or very closely watch on our portfolio watch list. So let's jump in now. 2013, they were down around 5%. We can see it right now trading in the midpoint of the 52-week range, and it currently has a very minute yield of 0.26%. Now, if you've been holding this over the last 10 years, you would be up around 382%. Very strong. Remember, it doesn't include those dividends reinvested, and it did peak at the back end of 2021 at around $667. So let's take a look at the financials. Now, income statement, top line revenue, we like to see 3 to 7% growth year on year. 24 billion reported in 2018, 45 billion in 2022. So very strong growth over the last 5 years. And when we take a look year on year, we do see increases which are very positive. We will take a look shortly at the last 10 years percentage wise too. But one thing to note, trailing 12 months, it does give us a sign that we are expecting essentially their top line to reduce slightly, which will be the first time over the last 5 years. As always though, do hit that subscribe and bell button so you are notified, and we will run through it when that is released. Bottom line, what story do we see here? Well, 2.9 billion reported of net income in 2018, just under 7 billion in 2022. So they've managed, whilst their top line hasn't doubled, they've managed to double their bottom line and more over the last 5 years. Very strong. Again, we note similar to the top line, their bottom line is expected to come down. And year on year, we see an increase all the way to 2021 before dropping in 2022. So overall, their top line and bottom line have increased year on year, although do note 2023 is expected to come down. There are some small inconsistencies as well, but overall it is moving in the right direction. Quick health check, total cash versus total debt, 2.1 billion of cash on the balance sheet in 2018, 6.2 billion in their latest quarterly report. So they've increased their cash position by around 3 times. How does that compare numerically and directionally to their total debt? Well, what we can see here, their total debt around 19 billion in 2018. Latest quarterly report nearly doubled at 35 billion. So they hold a lot more total debt, in fact, than they did 5 years ago. Yes, their total cash has increased, but not by the same amount. And we'll analyze that when we look at the net debt to EBITDA metric. Now, some of their competitors in the life science tools and services, we have DHR, which is quite a popular company, IQVA, as well as a few others. Now, essentially, the last year, 2013, it wasn't the greatest year for the industry. We do see TMO essentially down 4.5% with those dividends reinvested, DHR down 2%. We do see WST, though, the best performing, but it is essentially an outlier with the industry as a whole really underperforming. Over the last 5 years, well, what do we see? Well, for Thermo Fisher, in fact, we see up 140%. It isn't one of the best. In fact, you have 2 other companies, DHR, a better performance over the last 5 years, as well as WST. So what we can see, the industry as a whole has performed very well over the last 5 years. But as we always say, remember, past performance is never an indicator for future performance. Now, before we jump into the dividend safety and financial metrics, let's have a quick look at the institutions. 87% institutional ownership, 36 billion worth of outflows over the last 12 months. However, during the same period, 243 billion of inflows. So institutions like this company a lot more than those that don't. And we see the largest inflow in Q2 of 2023, although we do note slightly more outflows than inflows in 2023 Q3. But overall, over the last 12 months, institutions do like this company a lot. But as we always say, we never copy the institutions. It's just one layer of our research. Dividend safety score then 72, it is safe. Market cap 205 billion, a mega cap company. Now, recessionary metrics for those that see a recession in 2024. No dividend was paid, so no comparative data, although they had above average growth of negative 5.6. S&P average growth around that period was negative 12. and they also outperform the S&P negative 45 versus the S&P's negative 55. Now, this is a sign of a very high quality company. Dividend growth, double digit increase, Feb 23 at 17%, double digits on average over the last 5 years, 8% on average over the last 10 years, well above the minimum 4% we advocate on the channel to beat or keep in line with inflation. Although do note they have only been increasing their dividends for the last 5 years. Now, when we take a look at dividend yield theory, as always, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. We have a sign here of reasonable valuation. Some could argue slight undervaluation. Forward PE 24.7, so it is slightly above the 5-year average of 23.7. But as always, we never look at these in isolation and we draw our conclusions towards the end. Also note the health sector PE is 17.7, significantly below Thermo Fisher's 24.7. So let's get into the metrics. Now, free cash flow, we always look at this. Earnings is susceptible to manipulation by management through accounting. Remember, below 60% gives us faith management can offer those double-digit dividends increases that we have come to love with Thermo Fisher Scientific. I mean, well below 20%, in fact, every single year, with the more recent period below 10%. 2022, 7%, 2023, 8% expected. So this is a company that I expect over the next few years definitely to offer double-digit increases to the dividend, so that is a very, very strong positive, although it is worth looking at forward guidance. Free cash flow per share, well, 480 in 2013, in fact, more than tripled in 2022 at 1760. It is expected to remain fairly flat in 2023 before picking up again in 2024. Sales growth, I'd love to see this. We only essentially look for a minimum of 3 to 7% for steady, moderate growth, but we can see here nearly double-digit increases to the top line every single year. Although note 2023 it is expected to drop by around 2% as we mentioned in our financial statements analysis. Total sales then, what do we see here? 13 billion in 2013, 45 in 2022. It is growing fairly consistency, you could argue as well, so that is nice to see. Shares outstanding, they've done both. They've issued shares, diluting your position as a shareholder, as well as doing share buybacks, returning excess cash to investor pockets. But one thing to note is the net position is they have diluted your position. 366 million shares outstanding in 2013, 394 in 2022. Now, ROIC, what we look for here, 10% or more, gives us faith that management are able to effectively allocate their capital. The last 3 years, it has been above that, although decreasing, with 2023 coming in slightly under. So something just to keep an eye on moving forwards. Operating margin, free cash flow margin, very nice to see, above the minimums on both counts. Again, it is starting to fall down from their peak of 2021 and 2020 on the free cash flow. So something to keep an eye on, but still well above those minimums. And finally, the net debt to EBITDA, earnings before interest, tax, depreciation, and amortization, shows us two things: balance sheet strength as well as dividend safety. Now, these are the number of years it would take the company to pay off all of their debt net of cash on hand. 2.24 in 2022, it is below the 3. 2023 expected to come up slightly higher, but still below. So far that dividend does look safe, and there are no real worries with that balance sheet based on the information we have. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now let's get into the first model, Graham's valuation. We have the stock ticker symbol TMO, the earnings per share, the essential growth rate at 12 per analyst estimates, and then we have the average yield of AAA corporate bonds, and then the current yield of AAA corporate bonds. Now this gives an intrinsic value of $276 with the market value of $530, and we have our signal here of overvaluation. Now one thing just to note, we don't include this model for one for REITs or two for companies that do increase their top line quite rapidly, double digits, as we saw for TMO, so this isn't one we will include. So if we jump to the first model, we're using the multiples valuation model. We have companies in a similar sector and size. Again, we have their stock price, earnings per share, their PE multiples, their average PE. We then get their earnings per share of TMO to get the intrinsic value, and this comes to around $503, a few dollars shy of the market value. So again, this is a signal of overvaluation, but given the fact that when we have analysed these other competitors, they don't have the growth rate as well as the forward guidance growth rate as TMO, so therefore this isn't one that we do believe to be relevant. But as always, if you do want to include these in your own intrinsic value calculator, you can note these down, or as always, click on the pinned comment below where you can grab a copy of the model to run through your own companies or those on your watch list to get your own intrinsic values. We then have the first model. We're using the DDM model where we have the yearly dividends. As we see an average growth of 15.6%, lovely to see, double digits every single year. Forward looking, we've gone for 7.75%. Given this is still below the average, we do believe it is a fairly conservative amount. This gives an intrinsic value of $603, market value at $530, showing us that it looks to be undervalued. We then go on to the DCF model, the discounted cash flow, where we have our free cash flows year on year. Average growth rate at 18%, analysts looking around 12%, so lower than the average. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding to give an intrinsic value of $594. Market value, as we see here, showing another sign of undervaluation. So the intrinsic value is the average of those two models that we've just run through. And as always, if you do want to grab a copy of the model, do click on that pinned comment below where you can get to the intrinsic value as well as the acceptable buy price of companies on your own portfolio or watch list. Now, margin of safety, we typically start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. And we can see here, it would be a buy around $8 higher than the current trading price at $539. At 15%, we can see around $509. So right now for TMO, we see around a 10 to 15% margin of safety. In terms of what Wall Street see, well, they believe the share price to go up pretty much in line with the intrinsic value at around 15% over the next 12 months. So for TMO, we see around 10 to 15% margin of safety at the current trading value, with Wall Street expecting 15% upside over the next 12 months. This, I believe, to be a high quality company. We did run through the metrics. It is one to keep a close eye on the earnings quarter by quarter, which we will do. But overall, it is one that I am adding to my watch list. In terms of looking to buy, I would be looking at a higher rate than 15%. I would say anywhere between 20 to 25%, so 480 to 450. And if we take a look at the current trading value, we do see this is still within that 52-week range. So personally, this is one that I will be adding to my watch list as a strong contender for a new position in the portfolio. As always though, do let me know your thoughts in the comments below. Let me know if this is one you hold, one maybe you're looking to add, or if you've recently sold. As always, smash that like button if you enjoyed the content, hit that subscribe and bell button. As always, Happy New Year, catch you all in the next episode and take care.